Here's a summary of Chipotle's CMG 2025 Q4 earnings call, designed for easy listening. Introduction: Cindy Olson, Head of Investor Relations. Good day, and welcome to the Chipotle Mexican Grill Incorporated fourth quarter and full year 2025 results conference call. I'm Cindy Olson, Head of Investor Relations. Please note that today's discussion may include forward-looking statements, and actual results could differ materially. A reconciliation of non-GAAP measures is available on our website. We'll now hear from CEO Scott Boatwright and CFO Adam Rymer, followed by your questions. Scott Boatwright, Chief Executive Officer. Thank you, Cindy, and good afternoon, everyone. 2025 was a year of progress and resilience for Chipotle. For the full year, revenue grew 5.4%, though we saw a 1.7% decline in comparable sales. Our adjusted diluted earnings per share grew 4.5% to $1.17. Critically, we opened a record 334 new company-owned restaurants and 11 international partner-operated locations. We navigated a dynamic consumer landscape where guests prioritized value and quality, pulling back on overall spending. Our operational excellence, particularly during the recent winter storm, was instrumental in serving our guests safely and quickly. Looking ahead, our vision is clear: to build a stronger, more profitable Chipotle by harnessing our core values. Our comprehensive business review revealed that Chipotle's core strengths, high-quality culinary and best-in-class throughput, remain strong and relevant. We see clear opportunities to accelerate growth and sharpen our competitiveness. This has shaped our recipe for growth, which focuses on 5 key strategies. 1. Protecting and strengthening the core. This means driving operational and culinary excellence. A key element is accelerating the rollout of our high-efficiency equipment package, which improves speed and consistency, reducing prep time and enhancing throughput. We have 350 restaurants with this package now and aim for 2,000 by year-end. 2. Evolving brand messaging and menu innovation. We'll sharpen our positioning, increase marketing spend, and refresh campaigns to strengthen our value perception. We're introducing new LTOs, limited-time offers, at a cadence of 4 per year starting in 2026, including the highly anticipated return of Chicken al Pastor next week. We also see significant potential in group occasions, like Build Your Own Chipotle for families and expanding catering. 3. Modernizing our business model. We're relaunching our rewards program this spring to widen the funnel and leverage data and AI for personalized experiences. We grew our active members to over 21 million in 2025, and about 30% of sales are currently loyalty-driven, with significant runway for growth. 4. Accelerating global expansion. We opened a record 345 new restaurants in 2025, surpassing 4,000 company-owned locations. We're confident in reaching 7,000 restaurants in North America long-term. In Europe, we saw positive comps and improved economics, unlocking growth in key markets. In the Middle East, with our partner Al Shia Group, we plan to nearly double our footprint in 2026, entering new markets like Saudi Arabia. We're also on track to open in Mexico, Singapore, and South Korea this year. 5. Cultivating the best talent. Our people are the backbone. We had 23,000 internal promotions in 2025, demonstrating our commitment to career growth. We're also enhancing our leadership team with new hires in digital and emerging technologies to drive efficiency and innovation. We celebrate our 20th anniversary of the IPO this year. Our unwavering commitment to sourcing the best ingredients, delivering exceptional value, and investing in our teams remains our constant. I've never been more confident in the strength of this brand and our ability to win. Our recipe for growth will position us for success in any environment, driving transactions and long-term sustainable growth. Adam Rymer, Chief Financial Officer. Thank you, Scott, and good afternoon. We delivered sales in line with expectations, with accelerating trends through the quarter and into January. To support this, we strategically elevated our marketing activity. For the fourth quarter, sales grew 4.9% to $3 billion, with a comp decline of 2.5%. This included a $27 million gift card breakage true-up, which did not impact comparable sales. Digital sales represented 37.2% of total sales. Restaurant-level margin was 23.4%, down 140 basis points year-over-year, though it benefited by 70 basis points from the gift card true-up. Adjusted diluted earnings per share was 25 cents, flat year-over-year. We opened 132 new restaurants in the quarter, including 97 Chipotlanes. Moving into 2026, we anticipate full-year comparable restaurant sales to be about flat. While we are encouraged by the trends in January following our new protein menu launch, we are grounding our guidance in a conservative baseline due to evolving consumer dynamics. We will continue a disciplined pricing approach, but expect it will not fully offset inflation in the near term. Our Q1 pricing impact is expected to be about 70 basis points, versus inflation approaching the mid-single-digit range. This gap will narrow throughout the year. Cost of sales in Q4 was 30.2%, a slight decrease year-over-year, benefiting from menu pricing and lower dairy, offset by inflation in beef and chicken. For Q1, we anticipate cost of sales in the mid-30% range, driven by higher beef, avocado, and cooking oil costs. For the full year, we expect cost of sales inflation in the mid-single-digit range. Labor costs in Q4 were 25.5%, up 30 basis points, due to wage inflation and lower volumes, partially offset by pricing and lower bonuses. For Q1, we expect labor costs in the high 25% range. Other operating costs were 15.5%, up 100 basis points, primarily due to higher marketing, delivery, and utility costs, and lower sales volumes. Marketing spend was 3.5% of sales in Q4, and we expect it to remain in the mid-3% range for Q1 and low 3% range for the full year. Our balance sheet remains strong, ending the quarter with $1.3 billion in cash, restricted cash, and investments, and no debt. We repurchased $742 million of our stock in Q4, bringing our full-year 2025 total to a record $2.4 billion. The board authorized an additional $1.8 billion for share repurchases. The momentum we are seeing reinforces our confidence in our Recipe for Growth strategy, enabling us to compete with greater efficiency and impact. We remain committed to financial discipline and expanding our runway for extraordinary growth. Key financial metrics and forecasts. Q4 2025 revenue, $3 billion, up 4.9% year-over-year. Q4 2025 comparable sales, minus 2.5% full year 2025 revenue, up 5.4% year-over-year. Full year 2025 comparable sales, minus 1.7%. Q4 2025 adjusted diluted EPS, 25 cents, flat year-over-year. Full year 2025 adjusted diluted EPS, $1.17, up 4.5% year-over-year. Q4 2025 restaurant level margin, 23.4%, down 140 bps. 2026 full year comparable sales forecast, approximately flat. 2026 Q1 pricing impact, 70 basis points. 2026 full year pricing impact, 1 to 2%. 2026 inflation outlook, overall mid-single digit range. 2026 full year cost of sales inflation, mid-single digit range. 2026 Q1 marketing costs, mid-3% range of sales. 2026 full year marketing costs, low 3% range of sales. 2026 cash, restricted cash, investments. $1.3 billion 2025 share repurchases, $2.4 billion, significant risk factors highlighted or implied, consumer behavior shifts, heightened focus on value, reduced overall restaurant spending, and unpredictability of consumer trends. Inflation, ongoing cost pressures for key ingredients, beef, avocados, cooking oils, and labor. Global market challenges. France's wage inflation and occupancy costs were noted as difficult. Execution risk, successfully rolling out new technology and equipment, and integrating new marketing leadership. Competition, operating in a highly competitive fast food landscape. Highlights, record new restaurant openings, 334 company-owned, 11 international partner-operated in Q4, 345 total in 2025. Strong progress on operational excellence and deployment of high-efficiency equipment. Positive early results from the high-protein menu and marketing campaigns. Successful relaunch of loyalty programs and engagement strategies for younger consumers. Momentum in international markets, with strong cash-on-cash returns in key European locations and ambitious growth plans in the Middle East. Significant share repurchase activity. Lowlights, negative comparable sales in Q4, minus 2.5%, and for the full year, minus 1.7%, indicating challenges in driving existing store traffic. Restaurant-level margin decline year-over-year, primarily due to increased costs and less pricing leverage against inflation. Conservative full-year comp sales guidance of flat, despite encouraging January trends, suggesting caution about the near-term consumer environment. Most important statements from CEO and CFO, CEO Scott Boatwright. 2025 should be seen as a year of progress and resilience for our brand. Our path for further success lies in leaning into what differentiates our brand, accelerating innovation into new offerings and occasions that are of growing importance to our guests, and optimizing the in-restaurant and digital experience. Our recipe for growth plan will position us for success in any environment, and I am confident will drive transactions, allow us to move faster, and create long-term sustainable growth for the brand. CFO Adam Rymer. For the full year 2026, we anticipate our comparable restaurant sales to be about flat. This conservative guidance is a key takeaway. We will continue to take a disciplined and measured approach to pricing, but do not expect it will fully offset inflation in the near term, as we remain committed to delivering exceptional value for our guests. Margins in 2026 will be under pressure, and it's mostly due to our investment of taking less price compared to the inflation that we're experiencing. But again, I would emphasize that's temporary. This concludes the summary of Chipotle's 2025 Q4 earnings call.